Hi, my name's John Shearman. I'm the CEO here at Four Lines, and today I'm going to be presenting on the highs and lows of gold ownership. Before we start, remember this is an educational presentation. The material in this presentation should not be taken as investment advice. Do not use the material as the basis for any investment decisions. Thank you for listening. Okay, so there are three parts to this presentation. Firstly, we're going to look at why you might consider an investment in gold. Then we're going to move on to look at the different ways to actually gain exposure to gold. And then finally, we're going to run through some of the potential pitfalls of owning gold. So let's start by looking at why you might consider investing in gold. Well, gold has historically been a great inflation hedge. So numerous economists have demonstrated that over the long term, through both inflationary and deflationary periods, gold has consistently maintained its purchasing power. It's been a great store of value. Related to that, it's been a good currency hedge, so historically as the dollar has weakened, gold has tended to strengthen and vice versa, although the relationship has been by no means stable. The reason for this is gold can kind of be thought of as a currency, so as the dollar weakens against other currencies, it weakens against gold too. In addition, gold is priced in dollars. As the dollar weakens, the demand of foreign buyers for gold goes up, and therefore the price goes up. Flight to quality. So gold has often been the beneficiary of a flight to quality. It tends to look attractive when currencies and economies look as though they are collapsing. Although again, that flight to quality characteristic is not stable. And we've seen periods where gold behaves like a risky asset, like equities, and other periods where it behaves like a safe haven asset, like high quality bonds. There's demand for gold. There's significant demand for gold from emerging economies like India and China. And the demand for gold is primarily driven by jewellery, by the demand for jewellery. But demand for gold as a financial asset and industrial applications does also represent kind of an increasingly important, although still small, component of overall demand. And then finally, really because of all those factors, gold has diversification benefits. So it's not highly correlated with stocks and bonds, and it's diversifying and risk reducing when added to a portfolio that has significant allocations to stocks and bonds. So once you've decided you want to own gold, how do you go about getting exposure? Well, there's a number of ways. Firstly, you can buy the physical, either bullion or gold coins. And this is the most direct exposure to the physical asset an investor can get. If you are genuinely buying gold because of a concern over financial collapse, then physical is definitely the way to go. However, in anything but very small quantities, you're going to need to store and insure the physical gold. In addition, there's transaction fees associated with the buying and selling, and they can really add up. So what's an alternative? Well, you could instead buy an exchange-traded fund like GLD that owns gold. So this is a less expensive way to get gold exposure than holding the physical metal itself. However, if you buy GLD, you can't actually go and trade your shares for physical gold. Only authorized participants can do this. So you own a financial asset that's backed by gold. Thirdly, you could buy mining stocks. So mining stocks are a way to gain exposure to gold prices through corporate operations. Now, the cost of extracting an ounce of gold from the earth varies country by country and by company, but it's generally well below the current trading price of gold. However, the problem with buying gold stocks is you introduce equity risk, and that has multiple dimensions to it that don't exist when you own the physical. Fourth way is to buy gold futures contracts, so you can continually roll forward futures contracts to buy gold. There's no counterparty risk, it's got huge liquidity in the futures market, and it's easy to apply leverage, so you've got capital efficiency, the potential for capital efficiency. However, trading in the futures market involves substantial risks, and investors can lose more than they originally invest. So it's not something to be undertaken unless you really know what you're doing. Finally, let's look at some of the potential pitfalls of owning gold. Well, firstly, Warren Buffett doesn't like gold because he thinks it's an unproductive asset. So the example he gives, if you'd have bought 1 ounce of gold 100 years ago, today it's still 1 ounce of gold. It hasn't produced anything. If instead you'd bought farmland, then every year that farmland would have produced a crop. Similarly with stocks, if you'd have bought a basket of stocks 100 years ago, each year those stocks would have produced a dividend, would have been a cash flow. So it's fair to say that gold produces nothing. It is an unproductive asset. In addition, one could also argue gold is a speculative trade. A lot of hot money has rushed in. Retail money, hedge fund money, and that money could rush out as quickly as it came in. And indeed, we've seen that in 2013, for example, there's been over $18 billion of outflow from the ETF GLD. So gold is a speculative trade. It's really a psychological trade, and it's a real doomsday trade. And it looks as though, the world isn't going to end, and the US economy really could recover, and that's not good for gold. Finally, and probably most importantly, real rates are rising, okay, and gold yields nothing. So when interest rates are zero, there's no opportunity cost of owning gold. I own gold, I own short-term treasuries, both yield zero. However, when real interest rates rise, the opportunity cost of owning gold goes up significantly. And it's important to differentiate real rates and nominal rates. And the difference between a nominal rate of interest and a real rate of interest is inflation. So if nominal interest rates are 3% and inflation is 2%, then the real rate of return is 1% when you adjust for inflation. Now what we're beginning to see is a rise in real interest rates. So interest rates are beginning to rise, and they probably will continue to do so. But inflation expectations remain low. And that's bad news for the opportunity cost of gold. Okay, so in summary, gold is certainly a very interesting investment, and ownership comes with both risks and rewards. You might argue that right now the risks of owning gold do appear to be elevated. However, the most important thing to remember with gold is to make sure that you as an investor fully understand the potential rewards and the potential risks, and are very, very clear about exactly why you own it. If you have any questions about the content of this presentation, please feel free to contact me at j.shearman@4lions.com. That's ivlions.com. Thanks for listening.